Okay, the last thing I'd like to just refer to is an effect, is the issue of effect of tax treaties on the foreign tax credit. And if we look through a tax treaty, we will see that there's a few things that can affect foreign tax credits. One, remember, we've talked about the potential for differences in classification. A tax treaty can create mutual agreement on the definition of the category. Secondly, the two parties hopefully agree on what the source will be, so that you do not have a mismatch there. And then lastly, there will normally be a section, an article in the treaty which allows for, bless you, which allows for an admittance that yes, there will be a foreign tax credit. Sorry, Kristen. There will be a foreign tax credit, or alternatively, if the country has an exemption system, that the income will be exempt in the home country that is taxable in the country of source. And of course, also a tax treaty may reduce the amount of withholding tax, either eliminate it completely or reduce the domestic rate. Now, one of the parts of our course-wide case study was consulting services for an Indonesian client. We have Win in the U.S. providing services to a client in Indonesia, and we are saying that all of these services by the people are taking place inside the United States. They prepare a report. It gets given to FedEx. FedEx delivers it to the client in Indonesia. And further, we said that the amount of the fee was $100,000, which we'll say 100. We said that the Indonesian withholding tax is 20, so that the client sends a net payment for the services to Win. Win's receiving 80 of cash, and Win is the taxpayer with respect to the 20. Now, we said that this 20 of tax is based on the Indonesian sourcing of this on the basis that they think it's a royalty. There's been a purchase, so to speak, of information. That's how they're looking at it. From the U.S. side, the U.S. is looking at this and says, hey, this is a service. It took 500 employee hours to put together this information in this report, and as a result, when we take into account salary cost and other things, in the U.S. we said, I think there was the 100 of gross income. There was expenses, I think we said, of 62.5, and net income from this of 37.5. I think those were the numbers in the example. So the U.S. is going to apply its 35% tax rate on this 37.5. And let's, I don't remember what the exact number is, but let's say that that's roughly, let's say 14. Now, assuming that there's no tax treaty between the U.S. and Indonesia, what happens with this? What is the end result? When is the taxpayer on this 20? And when also is the taxpayer to the U.S. of 14, which gives us a total tax of 34 on 37.5 of income. Now that's one of those really terrible answers which I occasionally speak about. So what could a treaty do to this? Okay, so there is in fact a treaty between the U.S. and Indonesia. And if we were to look at it, we would find that the definition of royalty takes into account this kind of provision of information. And as a result of there being a category, a definition of royalty that would include this, both countries now say, okay, we have a royalty. We are in agreement on the classification of the income. Both countries will agree. The second thing is that because it's a royalty, what is the source? There's a source rule. And the rule says the source is the country of the payee. I'm sorry, the payor. So that the source is Indonesia. So now we have both countries agreeing on what the source is. So the United States is going to change its domestic treatment of U.S. source and will accept foreign source treatment. The third thing that's going to happen is that the parties have agreed that the withholding tax on royalty will be no more than 10% of gross. So now this 20 has been reduced to 10. Now, as a result of those three things, let's recalculate and see what the answer is. Okay, instead of we still have the same 14 here. However, yes, and we also have now, instead of 20, we have 10. So we now have, of course, 90 that will come up. We now have to figure out the foreign tax credit. Before, we didn't bother because the foreign tax credit we knew was zero. There was only U.S. source income. So now we're saying the foreign source taxable income is 37.5 over worldwide taxable income, because we're assuming this is the only transaction, 37.5 times the U.S. tax, which is 14. So we have a foreign tax credit limitation of 14. Now, we know that we take the lower of the actual tax paid or the limitation. Now, the actual tax paid is 10, and the limitation is 14. So we have 10 of foreign tax credit, resulting in 4 paid to the U.S. government. So we've gone from a situation where the total tax was 34, we've now reduced it to a total of 14. This is a typical example of what a treaty can do where it applies. Yes, Peter?
So just to clarify, that treaty treats the income that service, what would otherwise be service income, as foreign source royalty.
Well, it treats it as royalty, and then you look to the source rule in the treaty, and it would end up being foreign source, yes.
And so I'm just thinking, yeah, so I was just thinking if there was service income and royalty income, then they would have to like go into separate baskets, and then foreign credit wouldn't apply, but if it's just one type of income, and one,
yeah, you're right. Again, we're looking at it very simplistically by saying there's only one item of income. If there's only one item of income, it will be in whatever baskets it's in, and you really don't care about other baskets. It's when you have a number of transactions, some with high tax, some with low tax, that you care about baskets. Now again, the real world is that yes, you have to, because in a large corporation, or even individually, you can have income from various sources. When I was working outside the United States, I would have, of course, salary income or partner distributions or whatever it was. And what was the source of those? Well, to some extent, partly because I was working outside the United States, they were foreign source. If I had a local bank account, then I also had interest income that was foreign source. Two different baskets. When my wife prepares our 1040, God bless her, she's the one who's filling out 2 1116s. 1116 is the form for the foreign tax credit. One for the interest basket or passive basket, whatever it's called for that year, and one for the general or overall. Yeah, so the basket, in a sense, only becomes important when you have multiple income items. If you only are focusing on one income item, it doesn't matter which basket it's in, because you only have one item, one tax, and they go together. Yes, Glenn?
In the first scenario, the basket that the U.S. would require that the excess credit, 20 that couldn't be used, would be active.
Yeah, because it's their business to perform consulting services and put together reports. That would be general basket. So technically, yes, even though it's U.S. source income, the tax would be a general basket tax. And if, for example, the same group of companies that files a consolidated return also has those, export sales from U.S. manufactured products with title passing overseas, then they could use some of those excess credit, some of that 20, against the income from those export sales. Again, cross-crediting. That's a good question.